Greetings, everybody. Welcome to the Liberty Call. Today is Thursday, July 20th, 2023. Hope everybody's having a good day out there. It is, it is raining and sunny at the same time here at my house in Larkspur, Colorado. And it's been pouring and hailing the last couple of hours with lightning and upsetting my puppy down here. He's not happy. Although he did bring me, it's like a good retriever, he brought me his little alligator. Went upstairs before recording this so I could make my beard look good. I sit here and twist it all day, so I have to wet it down and comb it back out. But he brought me this. How nice. Let's watch him run. Anyways. All right. Well, I'm glad you're here. Thank you very much. If it's your first time watching Liberty Call, please, if you could, give me some thumbs up, like, share, subscribe, follows, press all the buttons down here. Just hit them. Send this to your friends, to your family, even to people you don't know. I mean, spam them. I don't care. Anyways, kind of a mixed day here in the markets. Technology really took it in the nuts, and the S&P not as good. The Dow was, did pretty well today, but kind of a mixed day across the globe altogether. So, all right, well, let's go ahead and jump into the indexes and see how they did today. The Dow Jones was up 0.47%, 163 points, closed at 35,225. The S&P 500 was down 0.67%, closed at 4535. Nasdaq was down 2.05%. So I think probably the bond market is probably what's affecting the technology stocks. My assumption would be that bond rates or interest rates are climbing again, or yields are climbing again, which is putting pressure on technology. Let's see here. The VIX was up 1.67. It's currently at 13.99. Canada was down 0.26. Brazil was up 0.48%, and Mexico down 0.32. All right. Over in Europe, Germany was up 0.59. The UK was up 0.76. France was up 0.79. Netherlands was down 0.7. Spain up 0.72%. Italy up 0.36. Switzerland up 0.73 and Portugal up 0.85. Russian exchanges were split today. MOEX down 0.88, the RTSI up 0.14. And the overnights in Asia, the Nikkei in Japan was down 1.31%. Australia was flat at up 0.02. New Zealand flat at 0. In China, the Shanghai was down 0.92%. The Shenzhen component down 1.06. China A50 down 0.25%. DJ Shanghai down 0.8. Hang Seng down 0.15. And the Taiwan weighted down 0.28%. So like I said, kind of a mixed day. I would gather the reason that technology's looking, or the Nasdaq's looking so bad, probably has more to do with interest rates, having not dug too deep into it. That would be my personal guess. All right. Go to the market recap. S&P 500, Nasdaq, S&P fall as Tesla, Netflix weigh, Dow poised for ninth straight climb. All righty, let's get to my notes here. Should have had this ready, but I didn't. All right, on Thursday, the S&P 500 and Nasdaq experienced declines, primarily driven by drops in Tesla and Netflix following their quarterly results. Tesla shares fell significantly after reporting a drop in second quarter gross margins, and CEO Elon Musk hinted at more price cuts. Netflix also slumped at its quarterly revenue as its quarterly revenue fell short of estimates, leading investors to exercise caution and reconsider high-flying growth stocks. In contrast, the Dow Jones Industrial Average continued its winning streak for the ninth consecutive day, boosted by gains in Johnson & Johnson. The healthcare giant stock rose after reporting strong results and raising its annual profit forecast. The Nasdaq has been a standout performer this year, surging about 35%, thanks to an impressive rally in mega-cap growth names like NVIDIA and Meta, and also interest rates. They've been kind of stabilized for the last couple of months, which has really helped, driven by optimism surrounding AI and a resilient U.S. economy. Additionally, investors have been hopeful that the Federal Reserve's aggressive rate hike cycle might be nearing its end. Again, lower rates help technology because the way they do their valuations for the future, the lower the interest rate today, it helps increase the value into the future. So again, it's a big fancy calculation. I'm not going to get into that right now. All right. Economic data released on Thursday showed the labor market remains tight while manufacturing sectors continue to face challenges. United Airlines also contributed to the positive sentiment in the market as the airline lifted its full year profit outlook and reported record-breaking quarterly earnings due to robust demand for international travel. As for ongoing earnings season, with 77 S&P 500 companies having reported their results, second quarter earnings are expected to have declined by 7.9%, according to Refinitiv data. This is higher than the 5.7% fall that was initially anticipated at the beginning of the month. In terms of market breadth, declining issues outnumbered advancing ones by on both the NYSE and the Nasdaq exchanges. Despite the overall decline in some tech-heavy sectors, the S&P 500 recorded 31 new 52-week highs and only 2 new lows, while the Nasdaq Composite registered 58 new highs and 60 new lows. Overall market sentiment remains very cautious, with some investors choosing to take profits in high-growth stocks and redirect their investments towards more stable and established companies. The Dow's continued winning streak reflects the ongoing preference for value and steady performers in the current market environment. All right. So, as far as those big tech things, or, the big movers and shakers that did really well during, the rally we've had for the better part of a decade, and, that's kind of coming to an end. I've had most of my portfolios in value, well over a year now at this point. So it was before the market turned over at the beginning of January last year. So right now, just been kind of sitting around waiting for the market to capitulate, bottom out, and then we'll go back to the growth side of the asset classes. All right, next up, we got some labor data. U.S. labor market is still tight. Housing market slump persists. The number of Americans filing new claims for unemployment benefits unexpectedly decreased last week, reaching the lowest level in 2 months. The Labor Department's report raised cautious optimism that the U.S. economy might avoid a recession, despite concerns about inflation and the Federal Reserve's effort to curb demand. Yeah, they could keep, that's been one of the common threads is, avoid recession, soft landing. I don't see it. I mean, the Fed created this problem. I don't see how they're going to get out of it without some major damage. All right. Initial claims for state unemployment benefits dropped by 9,000 to a seasonally adjusted 228,000 for the week ending July 15th, the lowest level since mid-May. This decline was unexpected as economists had forecasted 242,000 claims this week. The ongoing tightness in the labor market and robust wage growth are supporting consumer spending and contributing to the economy's resilience. Analysts noted that the warning signs of a recession have diminished and companies are cutting back on layoffs. The current labor market strength is in stark contrast to historical recessions where job losses were much more pronounced. The decline in jobless claims might have been exaggerated by difficulties in adjusting the data for seasonal patterns. Plant closures in the automotive industry during July for retooling purposes can create fluctuations in claims data, making the adjustments challenging. The labor market strength is further demonstrated by the low level of claims relative to the size of the labor market. Claims remain significantly low, below the threshold of 280,000, which economists consider indicative of significant slowdown in job growth. The Federal Reserve is expected to resume its interest rate hikes in response to the strong economic conditions, despite data showing that the leading economic index dropped for the 15th consecutive month in June. Economists believe that the weakness in some sentiment-based indicators does not indicate a strong recession signal. However, the housing and manufacturing sectors continue to face challenges. Existing home sales fell in June, partly due to a shortage of available houses and higher mortgage rates, potentially pricing out first-time buyers. While housing prices stabilize and economists hope that more homeowners might decide to put their homes on the market, easing the supply shortage. Factory activity in the Mid-Atlantic region also remained subdued in July, with softer demand for goods and higher borrowing costs posing obstacles. Nevertheless, manufacturers are more optimistic about business conditions over the next 6 months. Overall, the decline in jobless claims indicates ongoing labor market strength and resilience in the economy, providing hope that a recession might be avoided. However, challenges in the housing and manufacturing sectors persist, and the Federal Reserve's monetary policy decisions will play a crucial role in the economy's future trajectory. All right. So one thing I do find dangerous is that they keep downplaying what the recession may look like over the next 6 to 12 months, and to say, we're past the worst of it, it's fine. I mean, that's just some very dangerous stuff to talk about, because the average, person out there is going to go, oh, that's fine. I'm going to go ahead and take some more risks now because everyone else is saying that, everything's good. But again, I just find that to be a very dangerous game to play, especially since, usually peak to trough is about a 50% drop. And we are nowhere near that. And we did not come anywhere near close to that over the last year. All right, last up comes from our friends at Mises Wire. It's titled U.S. Consumers Are Suffering in a Less Than Robust Economy, written by Daniel Lacal. All right, Daniel Lacal, the author of this commentary, argues that Keynesian policies, specifically massive government spending and currency printing, are having damaging effects on the U.S.'s economy instead of supporting it as intended. Lacal cites examples of weak labor market indicators, negative real wage growth, elevated inflation, and record levels of debt among citizens. In June, non-farm payrolls increased by 209,000, the smallest advance since the end of 2020, after downward revisions in the previous month. The labor force participation rate and employment/population ratio remain below pre-pandemic levels despite years of significant entitlement and spending programs. Lacal asserts that workers are dissatisfied with the recovery and inflation is eroding their savings and wages. Yeah, I think, what was it, last week or early this week, someone came out and said that, with the wages that, people are actually ahead from where they were 3 or 4 years ago. And and then it was on Twitter, they then got a community note said, actually, with inflation, we're actually behind with real wages. So that wasn't quite the case. All right. Where were we? Spending plans. Okay. All right. Lacal attributes the negative economic consequences to the large government spending plans that have led to a federal deficit surpassing $7 trillion between 2020 and the first quarter of 2023. The argument is made that these spending plans were intended to strengthen and accelerate the recovery, but have resulted in a weaker than historical trend, negative real wage growth, and higher debt. The commentary suggests that the stimulus plan has been a key factor in driving inflation, citing studies that link money growth to higher inflation rates. Lacal raises concerns that the backlash from these stimulus plans could lead to a recession, and the government's ability to increase the deficit further is limited, potentially leading to a debt deflation spiral or stagflation. Remember that from the 70s, folks? Well, probably not. I was born in the 70s. I barely remember it. Lacal concludes by stating that new stimulus packages have reached a point of diminishing returns where they no longer have a multiplier effect and only make citizens poorer. He advocates for a shift towards savings and prudent investment rather than continued reliance on spending and debt. Overall, Lacal presents a critical view of Keynesian policies and their impact on the U.S. economy, arguing that they have not achieved their intended goals and may have contributed to negative economic outcomes such as inflation and rising debt. Lacal urges policymakers to consider alternative approaches to economic growth and recovery. My solution would be don't do anything. Just let it be. This country experienced massive growth in the 19th century through the Industrial Revolution because there weren't any rules. You could pretty much do, granted, there were some, businesses that had 10-year-olds, working and things like that in horrible conditions. We fixed most of those problems, but there's no need to have all these regulations and rules, which all they do is retard progress in the economy and make you and me poorer. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. Hope you have a wonderful evening, and hopefully we don't get any more rain. And I'll talk to you next time. Adios.